What's going on, guys? Welcome back to the channel. In this video here, we're going to be doing something just slightly different than what I've usually been putting out. I've been doing a lot of stock analysis videos, and now while that is extremely fun to do, I wanted to gear this video towards a lot of newer investors to help them avoid traps that a lot of these stocks might pose. So I wanted to just, go through IBM because I feel like this is a great company to learn from, because when I was young and stupid, I invested in this company and it's absolutely horrendous. So let's investigate IBM and figure out what traps exist within this business and how can you spot them in other investments so you don't make the same mistakes I made. So without further ado, here's IBM and let's dissect this in our stock research tool. Right off the bat, we're going to jump into the company metrics category, and this is where I like to determine, where this company's been in the last 5 years and currently where it's going to be heading. So with IBM, we've been on a little bit of a decrease. If I just pull out to the chart real quick, last 10 years has just been a falling motion of stock. Now, why is that so, right? And why would you invest in a company like this? Like, what compelled me to invest in a company like IBM? And I'll tell you exactly why. I invested into a company like this because of the dividend yield. And a lot of people would invest into a company because they see a high dividend yield. And I've talked about this in previous videos. Just because a company pays a dividend doesn't mean, one, it's safe, or two, you should just invest solely into that company for that payment. A dividend is the salad of the business. It's there, it's a little bonus. You can have it if you want or not, but it's not the meat and potatoes. And we want hearty meals, folks. And with a company like this, it pays out a 5% dividend, which is pretty hearty. And if you look at these numbers here, folks, right underneath, $5.9 billion is paid out through this business just to dividends alone in free cash flow. Our average free cash flow is sitting at 12, literally half. Now, our trailing 12 months category, we're sitting at $10 billion of free cash flow, slightly lower than our average. However, $6 billion of that free cash flow is going straight to shareholders. So that's something to just keep in mind. Now, why is this an issue? Well, I'm going to just jump forward just a little bit to our financial evaluations category and explain that right away. So we're scoring this company 4 out of 10. Now, where this mistake comes in is that we are losing revenue. So the company is decreasing in its revenue, it's decreasing its net income, and it's decreasing its free cash flow. So the company is shrinking in numbers. The biggest one to keep in mind, folks, is that this free cash flow number is decreasing at negative 22% over the last 5 years. This is horrendous because, as we just expressed, the free cash flow is probably one of the most important metrics to look at in a business. And if half of your free cash flow is paying out these dividends, that's half at the 5-year average. Now, if that is slowly decreasing, now your window, or the amount of free cash flow that you have available to actually play with within the business, either to grow it or pay down debt, which we'll talk about in just a quick second, that is now going to be less and less, because now you have to pay out that dividend, because that's something that you've promised to the shareholders of your business. Now, here's another thing: debt levels. Let's look at the debt to equity of IBM, sitting at 250%. This business just loves racking in debt. Like, I feel like such an idiot. Like, back then, I'm like, yeah, let's just buy IBM because, that's an old business and they pay a dividend. Look, you know how much debt that is? We want this number to be beneath 50%. If that number is beneath 50%, folks, that means the company is building the business through equity within the business. Actually, I said business a lot. Anyways, beneath 50%, that means they're building the business through equity and not through debt. But in the case of IBM, they're taking on debt to now grow this business. Now, what's the problem with debt? Well, guess what? Now you got to pay this debt off. And how do you pay off debt? Well, you need free cash flow. Well, congratulations, because now your free cash flow is now decreasing. So now you got to pay off this monstrous amount of debt, pay out your buddies that have invested into this business that's slowly sinking, and you're also not making that much money because now your revenue is growing down, which is ultimately going to affect your free cash flow. How do you turn this around? How do you turn this around? So these are some things that, I mean, this ultimately, the one huge mistake is what I'm trying to get at here is you have to look at the larger picture. A lot of people will just focus in on one thing. Like, oh, it's the revenue's growing, but yeah, but it's not making any free cash flow or not making any net income. Or in the case that I made was I bought this company for the dividend, and a lot of people will gravitate towards dividends because that's just being pushed everywhere on Instagram and TikTok and all these other financial, you know, pages saying, "Oh, get dividend, do dividend investing. It's a lot of fun," or whatever, and you're getting trapped in this business that is not appreciating, and it's just slowly dwindling down. But you got that $6 or whatever dollars in dividends, whatever the percentage comes out to be. Well, congratulations, the value of the company is also decreasing. Some other things to keep in mind of this business: share dilution. This business is also diluting you. They're issuing more shares, so that means you own technically less of the business. If a company has, let's say, 10 shares, right, and you own one of them, you own 10% of the business. Now, if they issue 10 more shares to make it 20, now you own 0.5% of the business. You don't want that. You want them to be buying back shares, granted if the price makes sense, and this is a business that's not doing that. So like, this is a company that's just breaking like all the cardinal sins of things that I don't want to see a company do. And likewise, you shouldn't want to see a company do this either. Like the current ratio, it's at 0.88. We want this number to be over 1.5. Now, with this number here, it indicates to me that they have a lot more liabilities on hand than they do assets, which is terrible. Granted, it makes sense because we just love taking on debt while being in IBM. So here's the thing. We got a company that's just going to be, that's being leveled by paying out the dividends, decreasing revenue, decreasing free cash flow, and decreasing net income. As a new investor or someone that's like looking at, you have to looking at a company to invest in, you can't gravitate towards one little thing. You got to see what is the full story going on. What is the full story being told with these businesses, right? Because look, there's a lot of businesses out there that are going to show like, oh, we got this deal coming up and we're doing this and we're making this and we're going to have this, and we're going to ignore that. All noise. You got to look at the numbers. You got to look at what is actually happening. What have they done? What is their track record? Because if you don't do any of that research, you are going to wind up in a trap like this and like me, and you don't want to be that idiot. You don't want to end up going into some sort of company that is promising you the world, and next thing you know, they're bringing you a little snow globe. I feel like that analogy kind of doesn't make sense, but you know what I mean. For the sake of it and just for the fun of it, let's jump into a price analysis of this business. I want to see what this company would be worth, because look, they're ultimately, even though a company is decreasing in revenue, there's still value to be found there. Now, granted, this business could definitely turn itself around. However, do I think it's going to do that? I probably not, because there's so much stacked against. Like, I would hate to be the CEO of this company. My God, like, this is like, like you gotta have thick skin for this business, because there is so much going on and so many things that are wrong. So before we jump into a price analysis of IBM, if you're enjoying the video, hit the like button, hit the subscribe button. It makes me feel loved, warm and fuzzy inside, and you know, it's just, it puts me in a really good mood, because businesses like this really piss me off, and I can't stress this enough, and I don't want people to make the same mistakes that I have made. So let's jump into a price analysis and determine what a fair price to pay for this business would be. So I'm going to populate these boxes here now, and I'll tell you why I populated them the way I did. And here we go. I'm going to just snap my fingers and it should populate like now. Okay, here's what we did. We took these numbers here and we looked at them. And what I did was I played around with a lot of negative numbers, assuming this business ultimately just decreases over the next 10 years. You know what? I'm going to be, because I'm a lenient person, I'm going to say it turns itself around and we're going to grow at 4% a year. Sticking with these revenue growth, profit margins, and free cash flow margins, this is something that we can all hit. So I stuck within their, on a fairly conservative side of things. Price to free cash flow hovered around what we're currently at, and PE ratio, someone in the low category. Let's put our desired return in at 13% and see what this business turns out to be. And it is not looking good. Okay, hold on. Check it out. Look at this. So we're sitting at $68 a share. However, with a discounted free cash flow section, assuming the company starts growing at 4% a year, it actually would hit. It would actually indicate that this company, based off these metrics here and our aggressive side, it would actually show that it might be undervalued. However, this is a business with a ton of debt, like we just said, and it has a lot of, just a lot of bags to carry. There's a story with every business, and you have to dig deep and figure out, how did it get there? In hindsight, it's 2020. You can look at a business like this and say, wow, I can't believe I invested in it, but it is what it is. Now, I don't want you to make those same mistakes. So you have to research, and what I mean by research is you got to look at who's running the company, who's running the business, what's their track record, and does the story and the numbers make sense? Don't make the same mistakes that I've made. Here's a video that you should definitely check out, and that's 3 things every smart investor does. You're a smart investor, right? You were educated just based off this video. Check it out. But if you like the video, I'll see you in the next one. And that's it. See ya.